Welcome to this explainer. Have you ever looked at a company's bank balance, seen a massive pile of cash, and thought, wow, they are having an incredible year, only to find out later they're actually operating at a huge loss? Well, it happens all the time. And that total disconnect happens because cash is, quite frankly, often an illusion. Your bank balance is likely lying to you about your true profits. So today, we're going to completely demystify that illusion by mastering year-end accounting adjustments.
All right, let's dive right into the core of the issue. The illusion we're talking about is cash basis accounting. Recording transactions only when cold hard cash literally changes hands. But the reality, the true matching of effort to outcome, is the accrual basis. This is where we record revenues and expenses exactly when they actually occur, regardless of whether the cash flow is caught up yet. Grasping this principle is absolutely crucial. It's the bedrock of accurate financial reporting. So, to get a crystal clear financial picture, we're going to walk step by step through the 4 specific year-end adjustments every business needs to make: accrued expenses, prepaid expenses, accrued revenue, and unearned revenue. And here is our roadmap for today. It's a really brilliant 2x2 grid. We've got expenses on the top row, revenues on the bottom, prepayments on the left, and accruals on the right. It's basically a cheat sheet to make sure not a single dollar is misplaced when you're closing out the financial year. Let's start with our first quadrant, Section 1, Accrued Expenses, or Unpaid Bills. Okay, think of this as your classic unpaid bill scenario. An accrued expense happens when you've already used up a service, like say your employee's labor for the final week of December, but the cash hasn't actually left your bank account yet because payday isn't until early January. Because you absolutely owe this money soon, it has to be recorded as a current liability.
Let's put some numbers to this with Senyum Trading. First, we figure out the expected yearly salary. If it's RM 600 a month times 12 months, we expect an RM 7,200 expense. But if we look at the trial balance, we see we've only actually paid out RM 6,000 so far. So you just subtract what you paid from what you expected to find the missing accrued amount.
And there it is. Exactly RM 1,200 is still owed. That is your accrued expense. If we didn't do this calculation, Senyum Trading would look falsely profitable because we'd literally be hiding a whole chunk of our labor costs from the final reports. No way we can let that happen. So here's how this mechanic works in action. This RM 1,200 adjustment flows directly into the general ledger. We debit our salary expense account to bring our recognized costs up to the true RM 7,200, and we credit the accrued salary account. Ultimately, that RM 1,200 lands exactly where it belongs, right on the statement of financial position as a current liability. The illusion of extra cash is totally corrected. Moving right along to our second quadrant, Section 2, Prepaid Expenses, or Paid Forward.
Now, this is the exact opposite scenario. A prepaid expense happens when you pay for something in the current accounting period, but you won't actually use those goods or services until the following period. Because you've paid up front for something that guarantees a future benefit, it's treated as a current asset rather than an immediate hit to your profits. You essentially own the right to that service.
Let's break down Bistari Company's insurance as an example. They paid a full year's premium of RM $6,000 starting on March 1st. But for this calendar year, they only really utilized 10 months of that coverage. Those 10 months translate to an incurred expense of $5,000. So, we subtract that used portion from the initial RM 6,000 they paid, and the math tells us that RM 1,000 ringgit is just sitting there, fully paid for. That RM 1,000 ringgit isn't dragging down this year's performance. It's actually protecting the business into the next accounting year. If we had just expensed the whole RM 6,000 ringgit right now, our profits would look artificially low.
Check out how we handle this on the ledger. To prevent overstating our costs, we deduct that RM 1,000 from the insurance expense account by crediting it, which brings the expense down to the true RM $5,000. Then, we safely park that RM 1,000 debit under current assets on the statement of financial position. Perfectly balanced.
All right, shifting gears to the revenue side. Section 3, Accrued Revenue, or Unreceived Cash.
This one is fun. Accrued revenue is money you have completely, rightfully earned through your business operations, but your client, or maybe your bank, simply hasn't handed over the cash yet. You did the work, you provided the goods, but the check is quite literally still in the mail. Since someone legally owes you this money, it is recorded as a current asset.
Let's look at XYZ BHD. They have a principal fixed deposit of 100,000 ringgit Malaysia just sitting in the bank. Multiply that by an annual interest rate of 3%, and we find our total recognized income for the year. Even if the actual cash hasn't hit XYZ's checking account yet, the business has definitively earned a full year's worth of interest.
Boom! That calculation reveals $3,000 of completely invisible yet very real accrued revenue. If you only looked at your physical cash deposits, you would completely miss the fact that your money has been working hard for you in the background all year long.
To capture this hidden win on the books, we debit an accrued interest asset account and credit our revenue account for RM3000 to reflect our actual performance. When we pull our year-end statements, we list it as a current asset because, again, we have a legal right to receive it soon. Your profit and loss statement now accurately rewards you for making that investment.
And finally, we land in our fourth quadrant, Section 4, Unearned Revenue, or Cash Advances. So, unearned revenue happens when a customer hands you cash in advance for goods and services that you'll provide at a later date. Now, it feels amazing to have that cash in your pocket right away, right? But since you haven't actually done the work yet, you essentially owe it back to the customer. Until you earn it, this cash is a current liability. Let's break down Appapunadita BHD's rental property. At RM1,500 a month for 12 months, they legally earned $18,000 for the year. But looking at the trial balance, they actually collected $19,500 in cash. The difference between what they collected and what they earned reveals the advance payment.
That leaves us with an excess of RM1,500. And right now, that is entirely unearned. It represents 1 month of future rent paid early by a tenant. You absolutely cannot claim that as profit this year because you haven't actually provided the space for that future month yet.
To fix this illusion, we have to adjust the accounts. We deduct that RM1,500 from the rental revenue account by debiting it, logically reducing the revenue to the true RM18,000. Then we credit our unearned rental revenue account, logging it as a current liability. Why? Because technically, right at this moment on December 31st, you owe the tenant a free month of rent.
Which brings us to the ultimate question. The next time you check your business bank account, I want you to remember these 4 adjustments and ask yourself, is the number I'm looking at reality or just an illusion of timing? Mastering these accruals and prepayments gives you the power to see the absolute truth of your business health. Thanks for joining me on this explainer, and remember to always look beyond the surface.